Why do highly educated, rational corporate professionals willingly hand over thousands of dollars to unverified financial signal channels during a massive economic downturn? You sit at your desk at 11 p.m., watching relentless inflation erode your monthly savings despite slashing every single non-essential lifestyle expense. Suddenly, an enticing advertisement promises a predictable escape route through an automated wealth generation system that guarantees effortless financial sovereignty. Yet, transferring your remaining liquid capital to these premium masterminds right when your disposable income is lowest defies all basic mathematical logic. The answer does not lie in your lack of willpower, but within a hidden cognitive blind spot that specialized marketing systems intentionally weaponize. In the next few minutes, we will expose the exact psychological mechanism that forces rational minds to trust unverified algorithmic trading software. More importantly, you will discover the precise architectural framework required to insulate your hard-earned capital from these high-fee wealth management bootcamps forever. To understand this systemic vulnerability, we must first analyze a foundational economic metric known to behavioral experts as the loss aversion coefficient. During severe market contractions, the psychological pain of losing $1,000 is mathematically doubled compared to the pleasure of gaining that exact amount. This extreme emotional asymmetry completely distorts your internal risk assessment matrix, making long-term strategic compounding feel completely unviable and painfully slow. This mental distortion triggers a specific systemic metaphor we call the Flawed Horizon Machine, which alters how your brain processes market data. Under chronic financial anxiety, your cognitive horizon violently shrinks from a resilient 10-year investment plan down to a chaotic 24-hour options trading cycle. Your brain desperately seeks order, foolishly mistaking random macroeconomic noise for highly structured, predictable algorithmic patterns hidden inside trading software. Aggressive financial masterminds explicitly exploit this urgency bias by packaging basic technical indicators into premium, high-fee automated AI masterclasses. They leverage the scarcity heuristic, creating synthetic deadlines that force you to buy expensive packages using capital you cannot afford to jeopardize. By promising immediate liquidity, they successfully extract remaining consumer funds, redirecting your defensive capital into their own highly profitable subscription models. Systemic economic changes demand structural intelligence, not emotional desperation, if you truly want to escape these modern marketing loops. Upgrade your behavioral financial literacy right now by subscribing to Economecha and permanently protect your hard-earned assets from cognitive exploitation. To fully comprehend the long-term impact of this behavioral divergence, let us execute a comprehensive mathematical comparison spanning an 18-month timeline. We will track two distinct retail investor profiles, each starting with an identical baseline of $5,000 during a prolonged period of stagnation. Profile A chooses immediate action, depositing their entire $5,000 principal into a premium AI wealth bootcamp, hoping for rapid automated market returns. Within weeks, this aggressive approach triggers a severe cascading effect, losing an additional 40% of capital through volatile day trading options simulators. The unverified algorithmic signaling channels constantly encourage high-frequency volume, which quietly generates massive commissions for the platform while destroying retail equity. Meanwhile, Profile B completely rejects the emotional urgency loop, adopting a highly disciplined strategy focused on systemic, automated wealth generation methods instead. By refusing to chase random market noise, Profile B successfully isolates their capital from predatory fee structures, creating a stark performance divergence. As the 18-month economic stagnation period progresses, the structural disparity between these two opposing consumer choices becomes mathematical destiny. Profile A remains trapped inside the manipulative marketing loop, watching their initial capital continuously bleed out into hidden transaction costs. Conversely, Profile B experiences zero friction, systematically diverting their hard-earned funds into low-fee index funds that compound silently without active intervention. Instead of buying unverified trading signals, Profile B invests remaining liquid capital into high-yield micro-credentials to permanently upgrade their baseline earning capacity. The psychological toll on Profile A rapidly degrades their cognitive performance, forcing them to make increasingly desperate, high-risk trading errors. Profile B completely eliminates active trading fees, achieving total psychological equilibrium while protecting their core net worth from systemic market degradation. When the economic contraction finally concludes, the mathematical divergence between active emotional gambling and passive automated allocation reaches thousands of dollars. This real-world case study proves that premium masterclasses sell an architectural illusion, structurally designed to enrich creators rather than retail participants. True wealth generation during severe market downturns relies entirely on mitigating structural errors, not chasing high-fee predictive algorithmic trading software. To insulate your capital from these behavioral flaws, you must immediately implement a practical cognitive defense mechanism known as the Algorithmic Friction Protocol. This scientific asset management life hack requires you to structurally decouple your psychological urgency from your live digital wealth management interfaces. First, you must force architectural friction into your capital deployment workflow by embedding mandatory 48-hour cooling-off barriers on all premium purchases. By introducing a mandatory time delay, you break the dopamine loop that aggressive marketers exploit to extract your remaining liquid liquidity. Second, you must permanently deactivate real-time push notifications for all financial monitoring applications and volatile options tracking platforms on your devices. Constant exposure to fluctuating data streams continuously triggers your internal loss aversion coefficient, forcing your brain into a hyper-compressed trading horizon. Controlling your immediate digital environment is the single most effective way to eliminate the stress-induced urgency blind spot from your psychology. Tomorrow morning, you must execute a complete audit of your digital workspace to permanently realign your long-term wealth accumulation strategies. Delete every real-time tracking application from your primary mobile hardware, immediately stripping marketing masterminds of their direct psychological portal into your pocket. Replace those high-frequency interfaces with a highly structured, automated index fund ledger designed to track broad, long-term macroeconomic expansion silently. Reclaiming total psychological dominion over your asset portfolio allows you to remain completely rational while the broader market succumbs to collective panic. When you structurally disconnect from the urgent noise, you completely neutralize the manipulative marketing loops trying to capture your hard-earned capital. True financial sovereignty is never achieved by finding a hidden algorithmic miracle, but by mastering your own behavioral economics over decades. If you are ready to build a resilient, scientifically optimized asset allocation framework, subscribe to Economecha and transform your economic literacy today. Share your specific experiences with high-fee bootcamps or real-time trading anxiety in the comments below to help optimize our community intelligence matrix. Maintain your architectural friction, eliminate immediate cognitive vulnerabilities, and safeguard your capital balance from systemic financial exploitation, starting right now.